Adam,
Steve.
I'm excited about today's topic. We're going to talk about technology. That's timely and topical. So given what's happening in the markets today. So what I want to talk about today is how AI is impacting technology stocks generally, but specifically hardware and software. And before we get started in that, I just wanted to kind of set the stage that, I mean, if you look at the last 20 years or so, software stocks, technology software stocks have widely outperformed hardware technology stocks. And that's because of their, just the better economics of their business model, right? But this past year, especially even the last few months, you've seen investors focus more time and attention on hardware companies, while software stocks have gone through a pretty significant decline generally as a group because of concerns of AI disrupting their business models. So I want to get your opinions a little bit about this emerging AI theme and how you're thinking about it from your portfolio holdings and hardware ideas versus software ideas. And then we'll get into each of the specifics, hardware companies first and then software companies. And so thank you for doing this. We're going to have a good time. Mm-hmm. And so let's start with AI. So, this theme has emerged over the last couple of years, and investors are obviously beginning to rethink their portfolio holdings, which have been dominated by software companies for a long period of time, and moving more capital towards hardware companies. So how are you thinking about this and from a portfolio standpoint, and what adjustments have you been thinking about for your portfolios?
That's a great question, Steve, and I agree. This is a really great time to have this conversation, right, considering the major moves that we see in the marketplace. Yeah. So maybe setting the table by starting with a major development that happened earlier this year that really catalyzed this dramatic shift that we're seeing both in hardware on one side and software on the other direction, which is early this year, Anthropic, followed by OpenAI, made major advancements in AI-assisted software development. This transformed generative AI, which we've been familiar with as a society ever since the launch of ChatGPT, right, from a software tool that could really only do autocomplete, find the types of code phrases that would be helpful, to an independent agent that can be assigned tasks by the software developer it can attempt to do on its own very thoroughly with a very deep knowledge inside its training data of the code that is best applied in different places. It still requires human supervision, but the amount of power this gives software developers have described it as they've suddenly been given superpowers. Right. So a very real technology, very real usefulness, and this has led to two major developments in the market. One is that hardware stocks, any stocks associated with data center build-out, have seen a massive amount of capital flow into them, both from big tech companies like Microsoft, Google, Amazon, Oracle, and others, as well as external financing. And this has caused the revenues and profits of semiconductor companies, data center build-out companies to rapidly rise, forecasts for these to rapidly rise, and the valuations of these companies to follow that. On the other hand, software companies have caught the worst part of this narrative, right, which is the idea that there's a greater risk if software development costs head towards zero because AI agents become so capable. The barriers to competing with software companies have gone down, and this has caused investors to take a sell first and ask questions later to the sector writ large.
But the impact on AI can't be applied across the board for software companies, right?
Oh, the brush.
Broad brush strokes. So we'll talk about that in a second. I want to stay on the theme of hardware there, though. hardware companies have not traditionally been significant allocations in Kayne portfolios. Can you speak to why that is and why that might be changing going forward?
That's a great question. And maybe as a starting point, really quick revisit of who we are as an investment team and why that's led to this. We are quality investors. We're looking for sustainably, competitively protected businesses that will have persistent demand over decades. We want the business to be better 10 years from now, 20 years from now than it is today. One thing that has been risk, there's two main risks in the hardware businesses facing semiconductor industry that have kept us to have an underweight over time. The first is the customer concentration of hardware providers. Because the semiconductor supply chain is so capital intensive and there is long lead times to adding capacities, you're talking about shrinking a chip to the size where even a human hair would be the size of a football field. Very few companies in the world can do this. TSMC has overwhelming market share in chip making. This causes all the suppliers to TSMC to have large customer concentration to TSMC. TSMC's largest customer is a quarter of its revenues because you see great concentration in industries like GPU making, which is NVIDIA dominates, as we all know. And then NVIDIA itself, two customers represent 1/3 of its revenue because it faces the largest purchasers of GPUs, which are cloud computing businesses such as AWS and Amazon, right. Google Cloud and Google, Azure and Microsoft. This customer concentration, this customer power risk is exacerbated by the cyclicality of the semiconductor industry over history. I'd mentioned the lead times. Because semiconductor demand is uneven, these are capital goods that you typically purchase and then get a lot of use out of over multiple years. There's going to be investment cycles. And when everyone wants to invest at the same time, they're going to go to TSMC, they're going to go to NVIDIA, and all order at the same time. TSMC and NVIDIA can't add capacity at that rate that demand is going, so they put customers on allocation. They give them a percentage of the orders that they require. This causes customers to order more right. than they are expecting to Double use ordering, right. in order to get the allocations that they're really looking to have. Right. The flip side of this, when that cycle eventually happens, when people are no longer all trying to rush out through the same door to get the chips, the realized fall in sales is actually more than the fall in demand because of the rewind of the over-ordering.
So, I mean, how do you react when people ask if it's different this time? Is this hyperscaler capital expenditure cycle simply something that's going to be sustained, and the cyclical characteristics of these businesses or somehow has been structurally changed, at minimum elongated, the cycle's been elongated, and maybe it's permanent? How do you respond to that?
That's a great question, because that's very much what I've been hearing. So if you look particularly in the area of the memory hardware makers, I think there were business school cases about using them as the example of a capital-intensive cyclical industry, right. Where there's a lead time to adding capacity. It's very capital-intensive, and everyone can add similar types of capacity, which is interchangeable with each other. Right. There's a narrative now that because AI will eventually be able to accomplish all jobs within the economy, produce incredible amounts of value, and that memory is a bottleneck because I don't want to go too deeply technical into this concept, but one thing that constrains AI right now is context windows. Like over time, as you add more information to AI, it kind of loses its working memory. At the hardware layer, that's constrained by the memory hardware. The narrative is because this is a bottleneck and AI can sort of become this perpetual motion machine and continue to create massive amounts of value. That being said, this ties into another concept I think we're probably going to dive into, which is the ability for AI to pay for itself,
right,
and then ultimately sustain this ability to invest in hardware.
Now, are there companies in the hardware space that you currently own?
There's companies in the hardware space that we own across various strategies at the Kayne investment team.
Right.
A lot of them have the exposure to AI, but they are not pure AI derivatives. They usually have a diversified set of industries that they service, including automotive and other types of chips. However, they've been benefiting from this really large demand upswell, and they usually have unique business characteristics that make them competitively differentiated. So even if they might have one or two competitors, they're the better mousetrap, let's call it, for supplying this type of chip. But because of the issues of cyclicality and customer concentration, it's been an area where we've been more underweight over time.
Okay. Well, let's shift the attention to software.
Mm-hmm.
So this has been a sector that Kayne has had a much larger exposure to. We've gone through this SaaS apocalypse. I wanted to make sure I got that right, where there was this broad brush approach applied to software companies that AI was going to eat all of their business models. Interestingly enough, even though we're recording this now, the last few weeks, you've started to see that narrative change now, and people are beginning to distinguish between certain subsectors of software.
Right.
So, maybe we've lived through this cycle already, and we're starting to see the other side of it. But it's traditionally been an area that we've been much more significant investors in. And so, I guess the first question is how when you have a few different software holdings in your portfolio, all of them are being impacted by this narrative around AI disruption. How do you distinguish between what is narrative versus true fundamental change? And have you seen any of the holdings that their business models are starting to be impacted?
Yes, if you're completely correct, software has been an area where, as a team, we've had more allocations to over time. And maybe starting with why that is, it's not that top-down we said we wanted to own software. Our philosophy has always led us to look for businesses that are a small portion of a customer's cost, but then provide such an essential service that either helps the customer earn more revenue or avoid breaking the law or avoid another form of catastrophic failure, that it gives them great pricing power. And software very much fits that mold. Usually the value that software can provide their business customers far outstrips the amount of dollars being paid to software. And then because the software businesses have this build once and sell many times model, it creates very attractive margins and ultimately profitability. Software has moved to this subscription model where it's year after year you get a recurring revenue. This compare and contrast with a cyclical investment type of spending pattern, so much more predictable. So there's certainly been a negative sentiment towards software, and all software, as you mentioned earlier, is not created equal. Just because we like software businesses does not mean that we would buy the sector writ large. If the only barrier to competing with the software business is the expense and time of developing the code base for the software, that is something even before AI, our team would have had no interest in owning. We're really interested in businesses with distinct competitive protections that we as investors can get really strong confidence in to own for decades. And when sentiment turns negative on these businesses, we can add to them at more attractive valuations. So what are some examples of these competitive protections? One is often businesses have multiple systems that they're already using. And a software provider will come in, and to get true use out of the system, which could be this command center to run your entire business, they actually have to do a lot of work up front in terms of implementation, connecting various systems. One great example in Kayne portfolios is Service Titan, which is the leading provider to trades businesses. So think plumbers, electricians, HVAC technicians. These are businesses that are very economically resilient because when your toilet stops working, your lights go off, and your air conditioning stops working, you don't delay that call. These trades businesses have basically made Service Titan their cockpit for running the business. Every personnel in that business will be booking a job with it, scheduling a technician with it. It has the schedules of the technicians. It has the map of where the technicians are real time. The technicians have a tablet at the job site, and they're able to show the customer what's wrong with the system on the tablet and what their options are for fixing it, and then quote it. And that's only possible because Service Titan did upfront implementation work to make that possible. And because they did that, they're able to introduce an AI agent to handle the booking of the job and reduce the amount of customer service representatives to a technician ratio and dramatically increase customer value much more than is being paid to Service Titan. Briefly on others, we look for network effects, staying regulatory compliant. These are other types of competitive protections that we look for, as well as the one I mentioned with Service Titan.
Have you had situations where you've assessed a portfolio holding, software portfolio holding, and determined that it's being impacted, and you've had to take action?
Absolutely. At the end of last year, in our growth portfolios, we very much thoroughly diligenced which companies we felt, given that there was this seismic change in AI productivity of software, which ones we would have less confidence in. And we have sold a couple, not all, of our software holdings. And one common motif I've noticed among the ones that we ended up selling was that they were encumbered by legacy systems. Specifically, they still had a lot of on-premise technology and they were not transitioned to the cloud. One benefit of the cloud is that you don't have individual implementations at each customer that have to be changed one by one. You can just change the cloud version of your technology and that updates across your customer base. Now, this gives an agility and speed of innovation that allows cloud native software businesses to incorporate AI capability much more adeptly than someone who's still in the midst of their cloud transition would be able to. And then oftentimes these hybrid businesses are facing competition from cloud native entrants using AI coding, embedding AI into those systems. So that will certainly be a competitive headwind for those types of businesses. And we have exited a few in those categories.
So if we could provide some, maybe some final advice to our clients that are watching this and they've watched significant at least short-term decline in software stocks and in this narrative emerging about the CapEx cycle and how that's positively impacting hardware companies. What's the guidance as it relates to what we're trying to accomplish as quality investors for our portfolio, what they should expect from us as it relates to the decision-making process of what might go into their portfolios, what might exit out of their portfolios?
No, that's a great place to take the conversation, which is if you might think, looking at the current market, why shouldn't we just sell all software, in fact, sell everything and just buy the hardware sector? My answer to that would be across sectors, businesses are not created equal. There's going to be businesses in certain sectors that are more commoditized, more cyclical, and then there are going to be businesses that have unique business models. They're an N of one. They're have no comparable peer, and those are really the ones you want to own. And those businesses are going to be able to compound their value through long periods of time, through various cycles, through various market narratives and market sentiments. And sometimes the most attractive time to acquire these unique businesses are when they're out of favor. And right now, software is very out of favor, and hardware is very much in favor.
Okay. I appreciate the comments. It's been an interesting time. You don't have an easy job of sifting through all of this in a really quickly changing environment. So we appreciate the comments.
Yeah, I really appreciate the conversation, Steve.
Thank you, Adam.
Thank
Appreciate
you.
it.